Thank you so much for everybody for tuning in. This is Harvey from the Passive Income Through Multifamily podcast. In today's episode, we have S.L. van der Zanden. He has a lot of experience, over 30 years of experience in the commercial space. He started his career actually putting deals together in the multifamily side. So I'm super excited to have you today, S.L. But with that said, yeah, of course. Can you tell us a little bit how you started your career in the real estate space?
Well, real quick, I'm a CPA. I was an auditor for a public accounting firm, worked on real estate, limited partnership auditing, got tapped by a headhunter to join a new private equity firm. And that's really where I learned the business. Because I was basically a quant and a due diligence person and a little bit of the marketing, basically between the acquisition and the actual raising of the money. I did that phase of the process and did that for about 3 years, joined another firm to set up an operation like that for them, and then got the itch, and at 29 started my first company, which replicated what I did at the or what the private equity firm did, because I was doing everything. And it was neighborhood real estate in Lincoln Park, the DePaul area of Lincoln Park in particular. It was called Chicago Neighborhood Investors, ironically, and did mostly mixed use commercial on the main streets like Armitage and Lincoln, streets like that, where it was commercial on the first floor and residential on the upper floors. Did a conversion of an apartment building, built a condo building from scratch that had commercial on the first floor with residential above, and did that for 5-6 years before transitioning to a family-owned office that did warehouse industrial real estate and office, and sort of cleaned house and rebuilt the company to work not just on the family's portfolio, but also third parties. And that was in my 30s. And then in my 40s, I partnered with a friend to be the real estate department for non-for-profits, like institutions like DePaul or Loyola or the Art Institute or the Boy Scouts, to take excess land and buildings and sell them to residential developers for mostly infill sites in the city, but some suburban sites as well, but all Chicago area. And then 15 years ago started Caprock, and our focus was on, because it was 2008, our focus was on distressed real estate. Worked that through the cycle. It built initially a property management group and receivership to control and manage the distressed real estate for lenders. And then as we grew, we built a leasing department and investment sales. And then in the last 5 years have started a group that I lead called Acquisition/Investments, which is what you and I talk about a lot, to invest in primarily commercial properties. Retail is our big sector. We've worked in multifamily multiple times, and like I said, I have roots in it, so I'm very familiar with owning and managing and ultimately selling those types of properties.
Got you. Oh, that's really good information you told us there. So I appreciate all of those good nuggets there. But I want to backtrack a little bit. Let's start when you first started in your 30s. So you started, just to confirm for everybody, all the listeners and the viewers here, you started in the private equity space, or was it, what type of
Yeah,
firm? What?
private
Okay.
equity. It was became the largest private equity firm in the country, specializing in tax shelter investments of real estate, taking advantage of, at the time, accelerated depreciation to cover the income that the properties generated, so that the investors didn't pay taxes, and it actually it sort of wiped out the investments, so that they really weren't out of pocket as over the course of the investment period. So it was an interesting time. It didn't last real long, and Congress changed the tax laws, and we had to go back to, cash flow focused, old-fashioned approach to real estate investment.
Gotcha, gotcha. Okay, that makes sense. So you, just for everybody to understand, so you're on the private equity side, you were doing the acquisition side of things, you were the marketing guy as well. You were basically putting the deal together from scratch, right? And
Right.
underwriting
Well,
it.
once the initial opportunity was identified by the acquisitions department, and they would negotiate a price, and then they would hand it off to my department, and we put together the due diligence analysis with the pro forma, the projections for the holding period, because of the tax focus, did analysis of the tax benefits from owning it, and then put together the marketing materials and legal documents required, because the money was raised on Wall Street. It,
Also institutional
it
money.
was so it wasn't publicly traded stocks. It was private securities
Okay.
that the large brokerage houses, say a Merrill Lynch or firms that don't exist now, would you take to their clients. So
Gotcha.
it would end up in the hands of mostly retail investors versus institutions, but we used institutions to get to that money, because they were big deals. I mean, my first transaction was $100 million acquisition of the Boca Raton Hotel and Club in Boca Raton, Florida, which was at the time the largest hotel transaction in U.S. history.
Oh, wow.
We bought apartments all over the South. We bought Holiday Inns, like 38 of them, center city locations that were corporately owned that Holiday Inn wanted to monetize, things like that. So they were big transactions. I did
Gotcha.
$1.3 billion in value during my 3 years there, which, in today's dollar would be like 3 billion or something,
Yeah,
something crazy anyway.
adjusted for inflation. Yeah. Well, that's very impressive, so that's very, very impressive. And that that's quite a track record right there. But let's progress a little bit in your career. So you did that in your 30s, and then you said, what went through your mind? You said, you know what, I want to start my own firm. Like, what initiated that for you?
So actually, I was in my 20s when
Okay,
I
okay.
did that. At 29 was when I decided to start my own company, and really it was the driving force was having control over my destiny, and not executing plans that came down from on high that you might not agree with, whether the agenda or the objective or the method of execution. So that was when I departed corporate world and started entrepreneurial, and really that's the closest thing that I've worked after that was the family office, but it was no real difference than what my companies have been. It was
Gotcha.
Less than 20 people, and everybody, knew each other in a much more familiar way than just, your typical corporate setup.
Gotcha. Okay, well that's very impressive too. So you start your own firm, you start buying multifamily buildings in the north side of Chicago. If you don't mind asking, because there might be some listeners out there that want to invest passively or actively in multifamily, what advice would you give them if they're going on to they're basically starting their own firm to buy multifamily buildings in anywhere in the US? What advice would you give them going in?
Well, what I focused on was emerging, neighborhoods. Um, like today, buildings that sold for a couple million, I've seen them transact at like, I won one of them that got away from me, that I was going to buy for a little over $1 million, ended up selling for 14 million a couple of years ago.
Wow.
So just crazy. I mean, that was on Armitage, which, if you go there, rents were $25 when I was there, and they're now 60, 80, 100, so
Wait, sorry, you
uh,
said $25 per month?
$25 a square foot.
Oh, per square. Oh, gotcha. Okay, okay, that
Yeah.
makes sense.
Yeah. So I think you don't want to be, I don't want to be the pioneer, the guy who says, oh yeah, someday, maybe in the next 20 years, this area is going to take off. You want to see there's already action, there's already activity, but there's a lot more room for growth. Trying to buy in established neighborhoods, you've got to be very selective, find a property that there's a reason why it's selling for less than what it'll be worth after you get done releasing it up or fixing it or both, so that you can create value. Because cash flow is nice, but you really want to also focus on what's going to be the end value of this real estate. And you can hold it forever, but you want to be able to, like owning stock, you want to see it go up in value, and
Mhm.
what if you're going to refinance at some point, you want to be able to do that in a way where you can maybe take money out that returns your capital. That is a strategy that I use versus some people will sell the property and do what's a tax-free exchange, which is called a 1031 in the business, to avoid paying Uncle Sam income taxes. But they're complicated. They're done in a pressure cooker kind of situation that leads a lot of people to make bad decisions. And avoiding taxes should not be ever more important than the quality of the investment. That's the number one thing to think about. And some people get distracted by the not wanting to write a check to Uncle Sam as more important than what the quality of the real estate is, and then they end up regretting it after they buy it.
Gotcha. Yeah, really good nuggets there. I hope a lot of people took notes on what you just said right now. That was really good advice there. But what was I gonna say is, so full disclosure for all the viewers and the listeners. So SL is actually my mentor in the syndication space too. So on H23 Capital. So he's helping us put together our first deal as well. So just full disclosure, I also work with him at the Cap Rock at his own firm as well. So I'm super excited so that we get to do some things together and try to grow up both of our portfolios to the point where passive income it's no issue. But I was gonna say, when it comes to the syndication space, what did you find like the hardest, or something you would have liked to know before going into that space, raising money from other people? Anything that you learn or something that you wish you knew before?
Well, what I learned, which wasn't a surprise or anything, but what got reinforced by it was the importance of communication with the investors. Some people are, once a year is enough. Some people want to know every quarter or month, and you sort of provide, now with email, it's a lot easier rather than mailing stuff, but you provide some level of updating on a regular basis is important for people to feel connected to their investment and to, be aware of what you're doing to, increase the value of that investment for them.
Gotcha. So constant communication, or would you say quarterly, monthly basis? What was?
Personally, since I run the acquisitions and investments for the firm and our partners, I do two things. We do have quarterly, sort of summations of what happened. But during the course of that quarter, rather than say every month on the 15th, you send out a little, announcement or newsletter or something like that. I do it more event driven. So you sign a lease, or you get financing, or anything, you finish a project, things like that. I find people like the news when it's fresh. It's easier to do when it's fresh too, frankly. And as you get more properties, time becomes more valuable, and you want to use it, as effectively as possible. So I get the best reaction from those event-focused communications.
Gotcha. That makes a lot of sense, actually, because they're more responsive, right? Whatever the information that you're giving them at that point after the event happened, it's really fresh in their mind because they can actually see the articles or in the news, whatever happened, right? Like, for example, if rates are going up, you can reach out to them right on the spot and be like, hey, this is what's happening with the rates. However, this is how it's affecting the property, right? Or the value of the property. So that makes a lot of sense. A lot of our viewers are passive investors, but we have a few that are active too. So I want everybody to get the actual distinction between the two, and I would say, I guess, the pros and cons from each of them. In your opinion, when should someone be passive, and when should someone be active? And then what would you say for someone that's passive when it comes to like finding a sponsor, for example, someone like you and me? What questions should they ask themselves before putting their capital to work with someone else? What are your thoughts on those two scenarios?
So active versus passive. My partners are active. My quote unquote active investors are partners who provide, direct input on situations, as we act, really by building a consensus of what the right action should be in a situation, versus the quote unquote passive investors. They're the ones I'm keeping informed, the event focus and quarterly, and make them feel like they're part of the process of building this wealth. And so, like, for instance, when a lease happens, I always not only talk about what the terms were, and I compare them to what the pro forma was in our original offering, but more importantly to me is I quantify what that did to the value of the property, because each lease adds value. because most commercial real estate, I should say, is purchased based on the lease income of the property more than the bricks and mortar. And that's really driving it. So if you're buying a property that's 15% vacant, as you lease up that 15%, I identify, okay, this added X amount of value to the property, which will come into play, at the point that we refinance. We haven't sold any yet, but if we sold, what the value is we could expect from a transaction to monetize the asset.
Gotcha. Okay. No, thank you for that information. Let me ask you, Estelle, how important, because there's a lot of people out there that probably don't really have a sense of how important it is to buy a property. Before you buy the property, how important it is for you to have a plan. How are you going to increase the NOI? For those who don't know what NOI is net operating income. How important is for people and folks to have a plan before buying a property, a value-add property? And full disclosure, SL right now and his firm, they're mostly focused in the retail space. But as you can already hear from a few minutes ago, he has a lot of experience in the multifamily space as well. But can you tell folks out there how important it is to have a plan, a detailed plan on how you're going to improve the property, and two, how you're going to give money back to the investors tax-free?
Okay, so there's a couple of layers there. First, I would say that we're going to do what we in the business call due diligence. You're going to investigate where are the rents today, how do they compare to your competitive properties. The market rate gets determined, but the other side of the equation is the expense side. And where is the current owner not maximizing the efficiency and the cost to operate the property, and that includes regularly appealing the property taxes, rebidding the insurance, two of the bigger items in your expense budget, but going through the landscaping, whatever, on an annual basis, what can we do that still gives good quality results, but at a better price. So that's one way of creating value. Well, actually two ways. And then the third way I hinted is just what are you doing with the spaces, whether they're unleased or leased? And it's what I call curating the portfolio. Maybe the tenant, let's say in multifamily, you have tenants that have been there a long time and their rents are not at market. And it's always a tough decision, but you probably can get the rents increase more than you might expect up front, or what the tenant will tell you they're willing to pay. But when push comes to shove, moving is not free and is very disruptive. And so a lot of tenants you can increase the rent to market with, and that's going to help with the operations of the property and the cash flow. If there's a troublemaker, get them out. Things like that. The better you've leased and managed the property, from an expense standpoint, the smoother it's going to be. And if you're like going to be investing in more than one property over time, you're going to have multiple properties, and they take time. And so you want to spend the first months or year or two really executing your business plan and getting everything as tight as you can, and then really that it becomes a passive income machine, and you're clipping coupons, as the saying goes. You're keeping everything in place and working, but you're not working as hard to do that, and that allows you then to go to the next property.
Okay, that makes sense. Yeah, a lot of people might call that mailbox money. Some people like to call it mailbox money, which I think is funny, but there's some truth to that too. And so let me ask you, we cover a lot of really good info here at SEL, but let me ask you, when it comes to your firm, where do you see yourself and your firm like in the next 3 to 5, 6 years? What's next for SEL in his real estate investment career?
Well, I'm driven to put together a portfolio of passive income that will, by the time I retire, will be my source of income, rather than, every day it seems like there's an article in the Wall Street Journal or wherever about, building a retirement nest egg, and how much money do you need to survive through your retirement years? How long are you going to live? How well is your health going to be? Things that are unknown, and which creates a lot of stress, versus my plan, which is having a portfolio that is generating more than what you need to live at the lifestyle that you want to live at, and which is self-perpetuating. And for people that are thinking about investing, and thinking about eventual retirement and then passing on, the laws currently allow you to mark the assets to market when they get passed to, let's say, your children. And so they start out, the capital gain that was built up in that asset is never taxed. And well, it's taxed if your estate is above the level where estate taxes kick in, which is, if in every day, every man's level, it's pretty high. So most people can plan on not being able to pass on the assets without a tax burden to their heirs, and that's my strategy. So it's different than the majority of the world, that the working world, that they put their money in the stock market and all other types of investments that increase in value. Some stocks create dividends, but a lot of them don't. So it's really about appreciation and riding the cycles, which are never ending in the financial markets.
Gotcha. Thank you. So that's a really good plan. I think a lot of people should aspire to do that. I believe creating passive income for the long term and then passing off those properties to your children and the children of your children, that's a really good way to build wealth long term. So that's what we're trying to teach folks out there, how to create passive income through investing in either multifamily, commercial, retail, just in the commercial space. But before I wrap this up, we have 4 questions that we'd like to ask all of our guests. You can only answer with one word. So I hope you're ready for that, because I know I didn't tell you about this. But before I do that, do you have any comments, anything you would like to say to anybody out there?
Um, if you're new to real estate investing, you know, uh, take the time to learn about it, both through the sponsor and your own research, so you understand the fundamentals and what the sponsor is attempting to do to create value. It will allow you to be more comfortable with the process. And secondly, uh, trust that over time, real estate is going to outperform the other markets and provide you the security of having a hard asset that's actually generating income versus gold or diamonds or a lot of hard assets don't actually generate income. And this does both. So it's not going to disappear and blow away like a financial asset can. There will be cycles where there will be vacancy at times. Rents may go down a little bit, but the steady long-term flow of real estate is increasing value. They're not making any more of it. And with global warming, the quantity of land is going to shrink. So it's all good.
Gotcha. No, thank you. Really good few nuggets there. So just to recap, one, educate yourself, whether you're passive or active. Please, always educate yourself before you start investing. And then second, if you're passive, make sure you're vetting the sponsor. For people out there that know what a sponsor is basically someone like me or SL. So someone who basically gets their hands dirty and manages the asset, in this case, multifamily or retail. And we're the ones who are actually on a day-to-day managing the actual investment itself. And then you as a passive investor, you're just basically collecting the cash flow. So that's what a sponsor is, someone like us. So always make sure you do your research on them and you're asking them questions when it comes to their background or their team's background or like their experience, their expertise, to make sure that you feel comfortable before you invest your money with them. But that's basically a nutshell. But I appreciate you, so I'm gonna ask you the 4 questions right now. Let me know when you're ready.
I'm ready.
Awesome. Awesome. So favorite real estate book?
It's Peter Linneman's, who was a professor at, oh, I'm giving you more than one
No,
answer.
it's okay. It's okay. You can go ahead. Go ahead. You can
Sorry,
go ahead.
he was a professor at the Wharton School at University of Pennsylvania. It has a multi-word titles which I can't spit out, but it's all about the financial side of investing, whether that's due diligence or structuring the debt, things like that.
What was the title? One more time.
It's financial investments in real estate.
Okay.
Something that's not exact
Okay.
because like I said, it's a longer title, but
Gotcha.
it's the Bible.
Okay. So just Google those words, guys, and you'll find it. Favorite city to visit?
Favorite city. Um, actually, London is probably my favorite. Um, you know, besides language, there's just a real connection between our country and theirs, and it's fascinating to see the roots of American culture.
Okay, that's a good one. I've never been, but I have to go at some point. Favorite cuisine?
Italian.
Nice. It's funny. You're like the second person I think that says that. Italian, you can never go wrong with Italian, right?
You never get tired of it. It's very healthy. It's very tasty, And I like anything Italian. I like the people, I like the country. I just think they've got a great package.
I agreed 100%. And then last question, what do you like to do for fun outside of work?
Outside of work, for me, maybe a lot of people wouldn't think it's fun, but I like strength training and different athletic activities. I'm a more of a loner than a team sport guy, so it's endurance sports. Like I when I was younger, I ran a lot. Now it's more triathlons, which are as mentally challenging as they are physically challenging. So I really get into the to what it takes to be successful in that kind of event.
Nice, nice. Yeah, I actually my older brother, he ran I think 2 or 3 triathlons now at this point. But yeah, those can be brutal. You really have to be very mentally tough to pull those off. So that's just something about you, SL.
Well, it's what really turns me on.
That's awesome. That's awesome. And before I let you go, SL, where can people find you? Instagram, webpage, where can people connect with you?
Well, LinkedIn, of course, would be which is linked to CapRock's page also. And then our website, I post, if you look under education, we've got videos and podcasts and things to provide, educational information.
Okay, perfect. Well, that's it for us, guys. I appreciate everybody tuning in. Either you're watching the video or listening to us on Spotify. And also, we're gonna make sure all of these links are in the description below for SL. So make sure you check those out. But without said, thank you guys for tuning to Passive Income Through Multifamily, and I'll see you guys in the next one. Thank you, SL.
You're welcome. It was good to talk.
Likewise.